Hi guys and welcome back. We had another amazing run in the first half of 2025, with the S&P 500 yielding about 7% and the Nasdaq yielding almost 10%. But we have also seen some very crazy stuff, such as the crash caused by tariffs that has been recovered in more or less 2 months. So what can we expect moving forward for the rest of the year? I'll try to make a guess at least, and tell you what I'm doing about it. Hi guys, my name is Giuseppe and I'm a finance graduate, former financial analyst and money nerd. And today I would like to express my opinion on where we are heading in terms of financial markets, what I'm doing about it and why. And since I'm going to discuss my personal strategy, please remember that this video does not contain any financial advice. So let's get started. Are we in an overvalued market? Well, we can say that we kinda are into an overvalued market, at least by historical terms. As you can see, the current Schiller PE ratio is among the highest it has ever been in the last 20 years. Second only to the situation in late 2021, when we had a massive 25 to 30% correction in both the S&P 500 and the Nasdaq, due to the Fed deciding to increase the interest rates all of a sudden to combat inflation and stop the pandemonium of growth that happened in 2021. By the way, if you want to get some exposure to the S&P 500 and the Nasdaq, you know where you can buy them? On LIGHTYEAR, that is an amazing and simple platform that allows you to buy ETF with zero trading fees. And if you open an account and use the code PEPE, we can both get $10 of free shares or fractionalized ETFs. How cool is that? But please remember that your capital is at risk, as your investment can go up and down in value. So, ladies and gentlemen, we can say that the current market is overvalued, at least by the standard of the Schiller PE ratio, that historically speaking has been very good at predicting market crashes. At these prices, the market is very nervous and volatile at any bad news, such as the recent discussions about submarines and the tariffs that we had recently. Historically also, we can see that the Schiller PE ratio over 35 has been correlated with negative return for the S&P 500 in the 10 years after. So this is definitely something that you want to consider when investing at these stages. What to do about it? Now, there are some people that are already talking about the possibility of a lost decade, or aka a stock market crash that is gonna take 10 years to recover. Now, here I'm going to express one of my personal opinion and call this BS. But not because I do not believe in the possibility of a stock market crash going forward, or at least a correction in the next 12 months, but because the last lost decade we have seen was 25 years ago, with the crash caused by the dot-com bubble. Now stay with me for a second while I share this opinion. Nowadays, with smartphone, internet and the speed at which information flows, we see that the market is incredibly more reactive compared to what it used to be 25 years ago. Think about how much has changed the behavior of retail investors, but also institutional investors as a consequence. And you can also kind of see this across the various stock market crash that we had in recent years. In 2020, we recovered in a few months, also due to the Fed intervention. In 2022, we recovered in a couple of years. And the recent correction caused by Trump talking about tariffs in the first quarter of the year has been recovered in a couple of months, give or take. So I personally think that due to the change in the infrastructure of information across the globe, I do not expect bear markets to last more than a couple of years. Unless some macroeconomic factor applies, such as a World War III or something, or a period of prolonged high interest rates. Faster information mean faster decisions, and this means more volatile markets. So crashes and recovery happen in a shorter period of time. And that is kinda why I don't think we're gonna see a lost decade anytime soon. Again, I might be wrong on this. This is my personal opinion. Only time will tell. What does this mean for you then? Well, in periods of overvaluation over historical standards, it might be wise to start accumulating some liquidity on the side to take opportunistically advantage of short windows of time, such as the one that we had due to tariffs at the beginning of the year. And that is why I'm putting some money aside on a high interest saving account that I can allocate in case of a correction. Think about it, liquidity might have a 0% return when it is not invested, but if you buy a 20% of a discount from all-time high, liquidity can easily yield 25% once the market recovers. And that can be potentially even just in a couple of years. Not bad, isn't it? So yeah, first and foremost, create a cushion of liquidity that you can use opportunistically. And second, option plays. On top of that, I'm also using options to hedge my positions a little bit. I'm covering my position creating a reverse risk collar. That is an option strategy in which you sell a call out of the money and you use the premium to buy a put out of the money. In this case, I sold at plus 10% out of the money call from the current prices and bought a minus 10% put from current prices. I did this on the Nasdaq index, and this strategy costed me something like $30 to be set in place. But it covers me for a notional value of about $55,000. And this is gonna cover me for the next 180 days. So what happens in this strategy is that if in the next 180 days my index position is gonna raise by more than 10%, I will be called out and lose my position, and I will be forced to sell at that price. That is going to be the current price plus 10%. So this creates a cap over my potential return in the next 180 days at 10%. Personally, I'm okay with that because I think that at these levels of valuation is going to be very hard for indexes to go higher than 10% in the next 180 days. And even if I get called out, 10% in 6 months is gonna be a very good result in any case. On the other hand, since I also bought a put option that is 10% out of the money, my losses on this indexed position are also capped at 10% for the next 6 months. So in the stock market, there is a say that says that the markets take the stairs to go up and they go down with the elevator. In other words, market increase very slowly, but they decrease sharply. This means that in any case, in the worst case scenario, I can lose 10% on my index positions that are my main holding. And we saw how steep and quick a market crash can happen at the beginning of the year, with the indexes losing even 20 to 30% in a few weeks. So the idea behind this strategy is quite simple. I think that we are so stretched in terms of valuation that it's much more likely that we're gonna crash from here, or at least get a correction, than have a sudden increase of more than 10% in the next 6 months. Again, this is not financial advice at all. I'm just presenting what I'm personally doing in the current market scenario and the ratio behind it. If nothing happens and the indexes stay between plus 10% and minus 10%, I will just have lost the depth of the position, that is about $30. So guys, to wrap it up, this is kind of what I'm doing. Not rocket surgery, nothing too crazy, just bought some protection and accumulating cash in case shit hits the fan. I hope you liked the video, and if you find this useful, please leave a like and subscribe and check my other videos here. Bye!